Hello, everyone, and thank you for tuning in for our July 2026 Investment Committee Update. I'm Stephen Weitzel, Managing Partner of Reveille Wealth Management. Today, I'm going to share our latest market perspectives and how we're using our rules-based investment discipline to inform our current positioning within our model investment strategies. Now, markets were mixed in July, with technology and AI-related stocks weighing heavily on indexes, primarily because of doubts that the return on AI spend that large companies are performing is actually going to benefit their shareholders in the near term. We saw value stocks meaningfully outperform the indexes this month. The NASDAQ 100 entered correction territory, meaning it's fallen by more than 10% from a recent high. The resumption of military action in Iran saw oil prices jump. Fears that those energy prices might remain elevated for a longer period of time stoked inflation concerns, leading to a rise in interest rates. Now, market expectations have also shifted markedly from where they were earlier this year on the future of Federal Reserve interest rate policy, with many analysts now anticipating at least one interest rate hike sometime in the next year. So let's jump into the big picture here. Markets were mixed once again in the month of July. Large cap U.S. stocks were down slightly, way down again by the technology and AI related names. The tech sector, although it did have one of the strongest days that it's ever had in history relative to the broader market at the end of July, it still fell by almost 9% during the course of the month. Small cap U.S. stocks were also lower, around 3.5%. We did see gains, however, in the more value-oriented areas within the stock market, which we will discuss in more detail later. Developed international stocks managed a gain in July, as did the commodity index. The bond market, however, suffered its worst month so far in 2026, falling by over 1.5% as we saw interest rates rise. Now, on our July 30th episode of our weekly show, The $1 Million Question, I covered some of the things that worry me in this market right now. If you go back to that episode, which we're going to leave a link to that episode here so you can watch it, I shared a chart that showed that July was one of the worst months since 2022 for many investors, because the sell-off in the most widely held stocks in the market right now shed well over 10% in July. Most of those names technology related, of course. But that really seems to be at odds with what's been happening in the market more broadly. The equally weighted S&P 500 index actually managed a small gain in July, while the headline S&P 500 index, which is more heavily skewed to the larger companies, declined. Now, in this chart, we're assessing the health of the market via market breadth. So this series breaks down what percentages of stocks on the New York Stock Exchange are above their 50-day, 100-day, and 200-day moving averages, respectively. So if a stock is above one of those moving averages, we could presumably assume that it's in an uptrend, whether it's short, intermediate, or longer term. Now, across each of those time frames, it seems that breadth has been improving. Ironically, in each of those right now, you have about 60% of stocks above those moving averages. So there's a 6 in 10 chance, if you throw a dart at a dartboard, that you would land on a stock that's in an uptrend. The problem that a number of investors are facing currently, or certainly faced in July, was that they were looking at too narrow of a group of stocks. So you got to broaden your horizon and your perspective and focus on things outside of just the technology sector. Now, if you've been with us for a while, you might recall that we highlighted the circular financing deal last September between NVIDIA, Oracle, and OpenAI. Well, Bloomberg News has now joined the chorus of those questioning these types of arrangements. They penned an article on the 27th of July that we encourage you to read, where they cast doubts on this practice. They cite concerns that NVIDIA, among others, have potentially artificially inflated demand and valuations across the industry. Now, the graphic from that article really takes the cake. It seeks to visually represent the exchanges of investments for services and hardware among a number of these currently large companies. So feel free to pause the video here for a moment just to try to take this graphic in. The trillion-dollar question is ultimately going to be, does this moving sand in the sandbox or circular type financing sharing arrangement, does it actually amount to anything? Or is it just, we're going to invest $100 billion in this company and they're going to buy $100 or $100 billion worth of goods and services from us? Is it going to be accretive, or is it all going to wash and it's just all for naught? So to be determined on that, but that is the big question that's being asked right now. One of the most important inner market charts that we could observe in the market today is the ratio of the S&P 500 tech sector relative to the S&P 500 index. So in May of this year, this ratio was able to eclipse a former high from March of 2000. And these types of breakouts are all noteworthy, right? But we're certainly skeptical that this one is going to be durable. In fact, we're concerned about what risks exist for the broader market should this breakout fail. We mentioned earlier how the NASDAQ 100 index has officially entered correction territory, meaning that it's fallen more than 10% from its recent high. But if we see this ratio get back below these former highs, then the selling in the technology sector, it might be only beginning. So we got to stay tuned and be on guard about what happens here in this ratio. Now, we're a month late sharing this particular data point with you, but it's related to this potential change in market character as it relates to the technology stocks. In early June of this year, we had something happen that's only ever occurred 8 times previously, and that was a single session where the S&P 500 technology sector underperformed the broader S&P 500 index by 4% or more. So this is not a data point that we believe that investors need to take lightly, even though it is a small sample size. Granted, we've belabored the point over the last year more about how we think that elevated valuations in the tech space don't present the best opportunity for investor capital longer term. But I just want to help to understand the potentials or the potential parallels to previous times gone by. So the first episode of the technology sector underperforming the S&P by 4% or more in a single day was right after the turn of the calendar in the year 2000. The major crisis that everybody was worried about, of having the double zeros in the date column and the computers going haywire, we ended up getting by that. So the market breathed this big sigh of relief at the beginning of 2000. Markets rallied very strongly, and the tech sector participated in that rally, but it certainly lagged what the index did. The next iteration from March 15th, where the technology sector fell by 1.75% and the broad market rallied sharply, this was the day following the all-time high close for the NASDAQ and for tech stocks, March 14th. So the very next day, substantial underperformance from the technology sector that would go on and give way to one of the largest destructions of investor capital that we'd ever seen. Fast forward to July of 2022, that was the 8th such occurrence of market underperformance on a single day from the tech sector. That one really marked capitulation, where investors were done puking up their tech stocks. The market would ultimately bottom in October of 2002. Fast forward to the present day. The NASDAQ 100 index peaked on the 3rd of June. 2 trading days later, we have another one of these episodes where the tech sector underperforms the broader market by more than 4% in a single session. How closely is that going to rhyme with the early 2000s? Time will tell, but we do not believe that we should be burying our heads in the sand on this. Too many people currently out there, we believe, are. Now, we had considerable volatility in the month of July, as we mentioned, in these AI-related stocks. Going to be a big portion of our discussion today. So you may or may not have seen a story on the news about how this young hotshot hedge fund manager saw his fund crumble by over 70% in just a few short weeks. That fund, ironically named Situational Awareness, Google it if you haven't seen the story, Situational Awareness, was absorbed by Ken Griffin's Citadel at the end of July. So the massive decline in this particular hedge fund, it stemmed from the substantial leverage that has built up in the system, most acutely around the areas of the market that have been really linked to these hot AI trades. Case in point, the South Korean Kospi Index. Now, from the peak of the market for the Kospi on the 19th of June until the recent low in late July, the Kospi's fallen by over 40% in just 27 trading days. Now, most of this increase has been driven by a single company, SK Hynix. SK Hynix is a semiconductor manufacturer, been highly tethered to the AI trade. Now, trying to capitalize on the near insatiable investor demand for exposure to the sector and specifically to that stock, SK Hynix, they elected to establish a listing on U.S. exchanges, on the NASDAQ, of course, on the 10th of July. So that listing traded as high as almost $195 a share before falling back near $130 at the end of the month. That's a 33% decline in only 11 trading days. And from the time that the listing started, down considerably from the jump. So as if that weren't volatile enough, there have been a plethora of leveraged exchange-traded funds that have been created that track the daily performance of some of these individual stocks alone, like SK Hynix and others, but they augment the daily returns of those stocks by 2 or 3 times. That is complete insanity. Now, this thirst for risk assets is perhaps being bitterly quenched at this point. SpaceX, as you'll remember, came public in mid-June at a $135 IPO price, just under a $2 trillion valuation. We covered the massive multiple in price to sales ratio that imputed that valuation going into the IPO. Well, the stock opened for trading publicly at $150, traded up to as high as $225 within 3 trading days. Made it easily one of the 10 largest companies in the world. But it fell by over 50% from that level over the next 28 trading days, putting essentially every investor who purchased the stock from the IPO onward in the hole. Now, curiously, the company following that IPO, they then sought to raise additionally another $25 billion in the bond market at the end of June, beginning July. And so, while I find it somewhat odd that they would float a debt offering almost immediately following the equity IPO, I presume that they do have express business needs for it. So I'm not questioning the legitimacy of the bond sale. But what was especially off about the bond offering is that this company, which had just IPO'd, became one of the largest companies in the world, that their bonds were rated as triple Bs, which was the lowest of an investment grade rating. But as Mr. Gunlock, who runs a large bond fund, as he pointed out, the yields on that bond, the spreads that investors required to be able to purchase the bonds, was more in line with a below investment grade rating. So How can it be that you have so much hype and fanfare around an IPO listing for this company's stock, where it's sold to the company or to the public as a company with all this tremendous promise, but the company's bonds that they issue fall into the high yield or junk category? Make that make sense? Very curious. Let's move on. We're going to talk about bonds a little bit here. So the Federal Reserve elected to keep interest rates unchanged at its July meeting, but they did have 2 voting members on the FOMC that advocated raising rates at the July meeting. Now keep in mind that the consensus Wall Street expectation coming into 2026 was that we would see 3 to 4 rate cuts from the Fed. Now, for those of you who are tuned in, have seen our reviews here, you'll recall that we've adamantly disagreed with that perspective and with that forecast. Our thought has been driven by looking at the front end of the U.S. Treasury curve. That's going to give us the best sense of where the Fed policy is likely to move. And it is quite clear now, given the rally that we have seen in the yield on the 12-month Treasury bill, that within the next year, probably within the next 6 months, the Fed is likely going to raise rates at least one time by a quarter point. So this is going to be done with the intention to arrest any inflationary pressures that remain above the Fed's 2% stated inflation objective. One quick side note on the new chair, Kevin Warsh. I do think in his press conferences that he comes across as a very pragmatic chairman. That's my perspective on it. He certainly is not a dove, which is what everybody thought was going to be the case because he was appointed by President Trump, that people were anticipating he would come in and just by default look to lower rates. He is not a dove. And I think that the market really seems to believe that he is serious about trying to tackle inflation and get it back to the 2% objective that the Fed has. He has stated in his press conferences that the Fed has not been serious about getting inflation back to that level, and that it has been above that target range for 62 or 63 consecutive months. And so he believes that in order to restore the credibility of the Fed, they need to be really focused on getting back below that level. And so I think the bond market believes that he is going to be intent on making that happen. So likely, probably going to see some rate increases, not cuts, from the Warsh Fed. All right, let's jump into some charts. S&P 500 index remains in an uptrend off of that big reversal from the April lows, but it has now posted back-to-back losing months, traded lower in both June and July, still in an uptrend. However, mid-caps, they too remain in an uptrend, but they also traded a little lower in the month of July, down around 2%. Similar story for small caps, remain in an uptrend, but the Russell 2000 down almost 3% in July, essentially giving back the gains that it had experienced in the month of June. Developed international stocks remain in an uptrend, but they traded higher in the month of July by just shy of 2%. So the index registered its highest monthly close in history by a fraction, but nonetheless, highest monthly close in history. But it still remains just below the prior inter-month highs that it had in late February of this year. So after a very strong advance throughout 2025, this asset class was due for a breather. And so it has spent 6 months just kind of going sideways and consolidating and digesting those gains. But if we can poke our head above those prior highs, it will likely be time for the resumption of this uptrend, and the next leg higher could be underway. So we're going to be on the lookout for that. Emerging market stocks had been incredibly strong, but they pulled back around 6% in the month of July. Now, We had mentioned how this index had become very highly weighted to some of these large Asian technology companies such as Taiwan Semi and SK Hynix. So as those names fell during July, it brought the broader index down with them. But we're still above these prior highs from 2007. We're now kind of trapped beneath some levels where we would have anticipated to see some resistance starting to come into this space. But again, emerging markets been very strong. Little pullback here in the month of July, mostly related to the exposure to the large technology stocks. We'll move to commodities here. They've been trapped beneath those prior highs from 2022 since March and April of this year, pulled back towards this upward sloping 200-week moving average, found some support there, have bounced higher. At this point, we really want to see if this index has the ability to eclipse those former highs from 2022. If so, that would give us good indication that it's ready for its next leg higher. Until then, we're probably likely to see some more corrective waves, some more consolidation is what's probably in order there. We'll move to REITs here. In an uptrend above the former highs from late 2024, this asset class has been an underperformer relative to the S&P for quite some time, but we do think that that could be changing here. So as the technical picture for REITs continues to improve on an absolute basis, meaning the longer that they stay above those former highs, then the higher the likelihood that they start to demonstrate some relative strength versus the broader market. So one of the stronger performers here in the month of July, REITs up around 2.5% for the month. Lastly, we're going to look at the bond market, which is effectively break-even or trendless at the moment. So it's very close to entering a downtrend. So we got to stay alert here that it may be time to exit some of the fixed income positions and just hold some money market for a little while. If interest rates are not going to stop rising, we're going to need to seek the refuge of the sideline and of money market for a little while. So while major U.S. stock indexes were mixed in July, largely due to weakness in technology stocks, many value-oriented, international, and equally weighted stocks continued to perform well, signaling that there is a healthy market beneath the surface. Our investment committee does believe that the AI investment theme is going to face some challenges and that there will be some skepticism on the ability for companies that are investing heavily in that space to have it turn in and yield results for shareholders. As long as there are doubts there, those names may be under pressure. Rising energy prices and persistent inflation have shifted expectations away from the Federal Reserve cutting rates to now many people are expecting that the Federal Reserve is going to be increasing interest rates sometime over the next year. Our developed international stocks remain in long-term uptrends, but emerging markets have had a little more volatility recently given their exposure to the technology and AI-related names. U.S. stocks, international stocks, REITs, and commodities generally remain in uptrends, but bonds are potentially showing some signs of weakness as interest rates have moved higher, putting pressure on those bonds. But despite these near-term risks that we see, whether they're technology-related, concern around market valuation, inflation, or higher interest rates, continuing to remain diversified and maintaining a disciplined approach is what's going to help our clients stay on track with their longer-term financial goals. So, thank you everybody so much for tuning in for this review. We hope that you have found it helpful. If you have any questions, please feel free to shoot us an email, info@reveillewealth.com. We're so grateful for the trust and confidence that you continue to place in us here at Reveille. Hope everybody has had a wonderful summer. Take care, and we will see you soon.